this crisis wouldn't start the way you expect. Here's the paradox. We live in a world with instant data, constant transparency, and real-time markets, yet the risk today may not come from missing information, but from too much accurate information moving too fast. In 1929, people stood outside the New York Stock Exchange because prices were 3 or 4 or 5 hours behind, and no one knew what their money was worth. The facts now are different. Prices update instantly. Insider trading is illegal. There's an SEC. There's FDIC insurance. Banks have capital requirements that were literally zero back then. On paper, this should make another collapse far less likely. But what this implies is more uncomfortable. If fear spreads today, it doesn't wait for clarification. It moves at the speed of a phone screen. We saw a version of this when a single message triggered withdrawals over a weekend at Silicon Valley Bank. And if the system seizes up again, the response is already written. Trillions, debt, and a bond market that may decide it's had enough. So the real question isn't whether 1929 repeats. It's how we get to something worse. The story you're told about 1929 is incomplete. It's easy to think it was just a market crash, one bad day that brought everything down. But that's not the full picture. After the crash, policies and decisions made it worse, each one dominoing into the next. The Federal Reserve stood by and did nothing. Tariffs were thrown on goods, crushing international trade. There was the gold standard, which limited how much money could be injected into the economy. And the result? A Great Depression that could have been avoided. But here's the critical point. Those policy failures were the real cause of the Great Depression. It wasn't just the crash that set off the chain reaction. It was the response to it, or the lack of response. And today, that's the part that's often missed. The way financial systems work today means the first spark could set off an even bigger fire. What happens if we hit that tipping point? There's something we're overlooking when we talk about risk today. Let's go back to Ben Bernanke's lesson from the Great Depression, something he learned while writing his thesis. When there's a panic, throw money at it. That was the playbook in 2008, and it's the playbook we used again in 2020 during the pandemic. But now there's an underlying issue that wasn't there in 1929, the amount of debt. Back then there was a budget surplus in the US in 1989. Today, we're looking at a $38 trillion national debt. And here's where it gets tricky. If a crash hits again, and the government writes a $5 trillion check to stabilize things, the bond market may start demanding higher interest rates. And once the US starts paying 3 to 4 times what it does now for borrowing money, it could spiral into an austerity trap. Austerity means fewer jobs, fewer services, and fewer options. Imagine the unemployment rate reaching 25%. It's a scenario that feels almost impossible to avoid when you factor in the current level of debt. But that's just the financial side of the equation. But the real danger today isn't just the debt, it's the speed of everything. In 1929, a crisis could only spread as fast as someone could physically run to a bank or a stock exchange. Now a single tweet can trigger mass withdrawals or a panic, and that's exactly what happened with the Silicon Valley Bank collapse. One person tweets, they're pulling their money out, and within hours it snowballs. People who never even heard of the bank now know about it, and they act on it. We've entered an age where the information doesn't have time to be questioned or verified. It's not just bad news that spreads fast, it's accurate news too. That means a single data point can spark a crisis, and once that moment hits, the system doesn't have time to react. It's a flaw that the tech-driven world hasn't fully reckoned with. So if that's how things can unravel in an instant, what happens when something much bigger goes wrong? The signs of irrational exuberance are already here. Back in the 1920s, the stock market was fueled by people buying on margin, taking loans to gamble on stocks they couldn't afford. Today, the same level of risk is bubbling up in areas like cryptocurrency, private credit, and the over-leveraging in private markets. Just a few months ago, the crypto market, which seemed invincible, took a hit as leverage and debt spiraled. And even if it's only $2 trillion in private credit, that's still a lot of money sloshing around without clear transparency. It's systemic, and we don't even fully understand its extent. But what's more concerning isn't just the hidden risks, it's the behavioral pattern we're seeing. People are chasing high-risk, high-reward opportunities. The fear of missing out, FOMO, has never been more powerful. The drive to secure a quick win has overtaken patience, pushing many to make choices they wouldn't have even considered a decade ago. This is where the real danger lies. If the market hits a bump, the wrong response could push things further down, and the consequences won't just affect a few people. Now let's look at how this will affect real people. When a financial crash happens, it's not just numbers on a screen, it's the millions of families and individuals who feel the impact. Unemployment rates spike, mortgages become unpayable, families lose their savings. It's a ripple effect that starts with corporate debt and flows all the way to the dinner table. The people who believed the system would always work for them are the first to feel the weight of its collapse. And when you dig deeper into the system, you start to see how inequality feeds into this cycle. More and more people are left on the sidelines, watching as others play a game they can't even get into. The fear of missing out drives risk-taking because the stakes are so high for those trying to get in on the action before it's too late. If this feels familiar, say so in the comments. We're seeing these warning signs again, and it's only a matter of time before the pressure breaks. Let's step back for a moment and understand how we got here. The system is built on a delicate balance. Banks need debt to grow, governments need debt to function, and markets need speculation to thrive. But what happens when these systems don't just teeter, they break? It's the invisible forces that keep everything in motion: incentives, the fear of missing out, and the ever-present belief that the market will bounce back. The constant chase for bigger returns is what drives this cycle. It's the underlying fear that if you don't jump in now, you'll miss your chance forever. The truth is, this cycle isn't a flaw, it's a feature. The leverage, the volatility, it's all baked into the system. It's what makes markets work, even when they're not really working for most people. And the scariest part, this system isn't just fragile, it's designed to self-correct. But in doing so, it often hurts the same people who already have the least. So when the market bends, will it break, or will it just snap back into place? We're at a crossroads, but there's no clear answer yet. If history is any guide, we have two potential futures ahead. The first is a managed correction, where governments throw money at the problem, as they've done before. They'll stabilize the situation for a time, but the cost could be higher interest rates and slower growth in the long run. The second is much darker. What if the bond market stops lending to the US at favorable rates? What happens when austerity measures kick in and the economy enters a tailspin, sending unemployment soaring and growth grinding to a halt? The truth is, we don't know which path we're headed down, but the momentum is clear. It's only a matter of time before the next shock hits and the next big move is already forming. Will we see another financial crisis, or will this be something different altogether? Whatever comes next, it will reshape the world as we know it. Here's the most important takeaway: the system is rigged, but it's not broken yet. The next crisis isn't about one bad day, it's about everything in motion, a complex web of debt, tech, and human behavior that can't be undone with just a single intervention. The game is designed to bend, but how much will it take before it breaks? The technology today, the constant information flow, the gambling on crypto and private credit, this isn't just speculation. This is how the system works now. The real question is, are we willing to pay the price for these cycles to continue, or is this the moment we finally rethink how we've built the economy? This story is far from over. For continued analysis, hit that subscribe button and stay with me as we follow the next twist in this unfolding drama.